In 1970, the average price of a new car was $3,400. A decade later, in 1980, that had doubled to $7,200. Over the same time period, the price of a home went from $23,000, tripling to $64,000. The price of milk doubled, the price of beef doubled, and gasoline prices quadrupled. Just over the course of those 10 years, the US dollar lost approximately 50% of its value. So $1,000 saved up at the bank in 1970 would have lost half of its purchasing power in just a decade later. The dollar losing purchasing power is something that is occurring at all times, but it happened to an extreme extent in the 1970s. And today, since 2020, we've been experiencing something quite similar. The US dollar has already lost 25% of its purchasing power since then, and as I'm going to show you in this video, we have a reason to believe that this is about to accelerate downwards again. Since 2020, the average price of a home has already gone from $350,000 to $500,000. Gasoline prices have doubled from 50 cents to almost $1, not to mention the price of beef and eggs that have both tripled since 2020. All of this has led to the largest inflation spike in the United States that we've seen since the 1980s. This is something called the Consumer Price Index, or the CPI, and it tracks how much the price of everyday goods and services change in a given year. This includes things like shelter, food, electricity, gas, transportation, medical services, and the list goes on. In 2022, the inflation rate reached a record high of 9% per year. Now, since then, it has cooled down quite a bit. Over the last 12 months, the US inflation rate has stayed between 2 and 3%, which is roughly in line with the Federal Reserve's target. Again, as we'll cover in this video, for the first time in years, we think there's a real risk that this begins to turn back up from here. Now, if we zoom out and look at what the inflation rate did in the 1970s, we see three distinct waves of inflation. If the 1970s were to repeat itself, that would mean headline inflation could exceed 10%. That would be disastrous. So let's zoom in and decompose the CPI to see exactly what is driving inflation today. The majority of inflation that we have today is being driven by shelter, or housing and apartment rent prices. As you can see, this is an extremely slow-moving part of the Consumer Price Index, and since early 2023, it has been steadily moving lower. While the price of homes in the US saw a huge increase between 2020 and 2022, they have cooled down considerably since. In fact, since 2022, you could argue that home prices have actually been declining. So if anything, the rate of change of shelter prices should be going negative, just like it did during the Great Financial Crisis. There's also no signs of seeing home prices turning back up just yet. Home sales remain at very depressed levels in the US as a result of high mortgage rates and the housing unaffordability crisis. Housing activity is currently at roughly the same level as it was at the heart of the Great Financial Crisis in 2007. Back then, we only saw home prices begin to trend back up when housing activity finally picked up in 2010 and 2011. So it seems the largest section of inflation today is unlikely to be turning back up anytime soon, which could actually provide further downwards pressure on inflation in the coming months. But as mentioned earlier, we do think that there's something that could push inflation higher by the end of this year, but it won't be driven by shelter prices. In fact, although shelter is the largest component of the CPI, it's not what typically drives inflation higher. You can see back in early 2021 and 2022, the large spike in inflation was driven primarily by food and energy prices that were ramping up at the time. Now, while these don't carry the largest weighting, they can have sharp swings that can really drive big moves in headline inflation. Now, understanding what truly drives inflation and the impact that it has on markets has allowed me to make some of the most profitable trades of my career. If your goal is to become a global macroeconomic trader like George Soros, who traded based on this exact kind of data, you have to watch the YouTube video linked down below that I put together that takes you through everything that I've learned about profitable macro trading. Understanding macroeconomics and having the right approach to trading is a very rare combination, but if you learn it, you can truly outperform. If the inflation rate begins to turn up here, the impact that is going to have on monetary policy and markets in general could be significant. If we overlay the price of oil on top of the inflation rate, you can see exactly why energy prices are so important to watch when it comes to inflation. Rising oil prices translates into higher gasoline and diesel costs, making it more expensive to ship goods and travel. These costs quickly ripple through the economy, raising prices for everything from food production to factory operations. And of course, these costs are quickly passed on to the consumer through higher consumer prices. In fact, looking back through history, most of the big inflation spikes that we've seen throughout recent financial history have been a direct result of higher energy prices. One plausible theory here is that rapidly growing emerging markets in Asia like India and China could lead to a pickup in energy prices, creating inflation in the US as a result. Now, if we look at oil demand from China as the second largest consumer of oil in the world, its oil imports have largely remained flat since 2019. They're going through a housing crisis and a demographics crisis. There's no clear signs of rising demand from China that could drive oil prices higher. If we look at India's oil imports, however, they've had quite a solid pickup recently, but since India only accounts for roughly 3% of total global demand, it's really unlikely that this triggers a meaningful rise in oil prices. In fact, since the start of the year, global oil supply has outpaced demand, keeping oil prices low. With the United States producing a record amount of oil and the US economy that's currently cooling, we don't think that this situation is going to change. So shelter prices are going down, energy and food prices are going down. That only leaves core goods and services. And by the way, both of these categories contributed to higher levels of inflation in 2021 and 2022. Back then, we had a combination of supply chain problems stemming from COVID that were putting upwards pressure on consumer prices, as you can see from this global supply chain pressure index. At the same time, the government was injecting trillions of dollars into the economy during lockdowns, as we can see from this huge jump in the United States money supply in 2020. And finally, there was a historically tight job market with an extremely elevated number of job openings relative to the number of people unemployed. This put significant upwards pressure on wage growth and contributing to the rising price of consumer goods and services. Today, none of these factors are present. Supply chain problems are virtually non-existent. The money supply has been curling up, but it's not growing anywhere at the speed it was in 2020 and 2021, and the job market has cooled down substantially. So yet again, all of these things that we typically use to determine where inflation could go next are actually pointing to inflation moving lower. So at this point, you might be confused. Why then are we expecting consumer prices to go up? And the answer to that is tariffs. Since February of 2025, federal revenue from tariffs has more than tripled, rising from $7.7 billion to now $26 billion. And although the impact of these tariffs haven't reached the consumer yet, we think they're about to. We can see why by looking at something called the ISM Prices Paid Index. And this reflects how much businesses are paying for their inputs. Over the past few months, businesses in the US have been paying significantly more, and a lot of this has been driven by tariffs. When we overlay the US inflation rate on top of the ISM Prices Paid Index, we can see this is a very reliable predictor of where inflation is going next. This is simply because businesses eventually pass on rising costs to consumers. And that's why there's a risk here of the inflation rate turning back up, at least temporarily. So to be clear, we don't think that we're in another 1970 scenario. Inflation is not heading to 10% from here. We think that's an extremely unlikely scenario given everything that I've talked about so far in this video. But it is possible that inflation picks back up above 3% by the end of this year. And that will have an impact on financial markets. The US Treasury bond market could be especially vulnerable to this kind of temporary pickup in inflation. Now, given the nature of tariffs, this will be a temporary pickup in inflation. After all, tariffs are a one-off increase. They're not an organic source of higher inflation. So ultimately, we do think that inflation will be heading back down after this temporary bump, which would benefit the stock market, for example. Again, if you want to learn how to trade based on this kind of information, I strongly recommend that you check out the video that's linked down below that I put together on this topic. These are timeless trading principles that I learned the hard way. You won't regret it. Thank you for watching.